Hi everyone, this is a short screencast for Independent Colleges Dublin for the ACCA P6 Advanced Taxation exam in June 2014. Okay, now the area that we're going to look at within this short screencast, it's part one of two. We're going to concentrate on termination payments and deal with share schemes in part two. Okay, so termination payments, what we're looking at is an individual who's employed, has some form of Schedule E income, and who's been made redundant. Their employment has been terminated. Okay, and in essence, I guess what we're looking to say is what element of the redundancy package that the individual receives is going to be exempt, and what element is going to be taxable. Now, I'll draw your attention to the slightly quirky slide in front of you, and really that number 3. So there are 3 basic areas and 3 sort of calculations that we're going to have to make if we see a question in June relating to this area of redundancy or termination payments. So just remember that 3 basic calculations in terms of where those calculations are going to go, most likely in some form of note to an income tax computation or perhaps a note to a report. Okay, so before I look at the 3 basic areas and the 3 sort of basic exemptions, just draw your attention to a general rule in this area. And the general rule is simply that if an individual receives a payment under Schedule E, and that payment is in line with their contract of employment, then that payment is going to be taxable regardless. Okay? It is going to be taxable. It's going to be put into our taxable pot. Okay? And the alternative to that really is that the payment is made ex gratia. In other words, it's not in line with the contract of employment. Okay? And in that case, the payment is either going to be exempt or partially exempt. So if you think about it, what we're looking to do is to really split payments that the individual is going to receive or is receiving into these 2 separate areas. And what we're allowed to do, as mentioned when we had the previous slide, is to look at 3 possible exemptions. And do bear in mind it's the taxpayer's option to take the highest exemption available. Yeah. So in terms of the exemptions, these 3 options where we're taking the highest, we've got a basic, increased basic, and then the SCSB or standard capital superannuation benefit. So in terms of the detail on these, I'll just take you through the first one. And that's pretty straightforward, really. We're looking at an absolute value of 10160 as a base level, and then on top of that, 765 euros for each completed year of service. Now, draw your attention to that word, completed year, not part years. Okay, so what we're looking to do to calculate the basic exemption is just to take 10160 and just multiply out 765 times the completed years of service. And I'll show you a quick example on that now. Again, this is from BPP text FA12 on page 38. So really what we've got here is an individual who has a certain number of years of service, been made redundant. The question's asking what the basic exemption is. And you'll see from the working below that all we're looking to do is to take the completed years, plus the 10160 and multiply by 765, and then we have our value of 20870 euros. Okay, so that's fairly straightforward. Let's move on now to the increased basic exemption. So the increased exemption, again, fairly straightforward, but subject to a couple of conditions. And all we're looking to do here really is add in £10,000 on top of our basic exemption. But, and there's always conditions when the revenue give us anything, in this situation, the conditions are that the individual has not had a tax-free redundancy payment in the last 10 years. And in addition to that, we're bringing in something called a pension lump sum. Now, essentially all that is, and it will crop up a little bit later as well, all that is really an amount linked into an occupational pension scheme that is tax-free. And that will be given in the question. So don't think that you're going to have to work that out in some way. That will be given in the question. Okay? So let's just remember then, increased basic exemption really £10,000 added to the basic exemption, but a couple of conditions. And I'd say most likely that the conditions will be in play. In other words, I'd say most likely that you will receive some sort of pension lump sum amount, and you're going to have to do some sort of calculation, so there will be a value. In other words, what I'm saying is that it's unlikely that number one condition would be in play. In other words, that there has been a tax-free payment in the previous 10 years. Okay, so in terms of a calculation on this, just following on from the example of John, from page 39, the BPP text for FA12, what we've got just down at the bottom here, you'll see that there's several options for the lump sum. So in this case, we've either got nil, 7,000, or 12,000. So I'll draw your attention to the value that the pension lump sum can be, and that's 10,000 euros. So just looking at the answer for this on the next page, the next slide. So we've got three different situations. Again, we're trying to work out what is the increased basic exemption. We know there's a cap of 10. In the first instance, we've got John with no pension lump sum at all. So in that case, we're simply just adding 10,000 euros onto the basic exemption, giving us 30870. In the second instance, we had a pension lump sum of 7,000 euros. So in effect, what we're looking to do is to really reduce that value of 10 by any pension lump sum. Okay, and that leaves us £3,000 being added to the basic exemption. Okay. Now, in the third instance, and this could be something that perhaps would be more likely of the three, in the third instance, we've got a situation where the pension lump sum was 12,000 euros, so in effect greater than 10. So there can't be any increase in the basic exemption at all. Okay. So moving on, the third item that we're going to look at, you remember on our slightly quirky slide earlier on, we had Terminator 3. So we're looking at three areas. It's the taxpayer's option to choose the highest exemption based on those three. So in this instance, we have the SCSB, which is just a sort of a convoluted name for the third benefit, the third exemption indeed. And this is really based on these three areas, okay? The average level of pay in the 3 years leading up to the date of termination, not the 3 last tax years. I draw your attention to that. You know, the length of service, and also, again, the value of the tax-free pension lump sum. Okay, so what we need to know for this particular area is the formula. In other words, how do we calculate the SCSB exemption? And it's simply by using what you see there on the screen, E times N over 15 minus L. Now, I'll draw your attention to a couple of tricks I've seen the examiner play on this area. And the first one really relates to something that I've just mentioned on the previous slide, i.e. that what we're looking to do is to get the average of emoluments up to the date of termination. So in other words, it's not the 3 years ending the 3 previous tax years. Okay, that's the first thing. And then really the second thing is we're looking to add in all pay and all benefits in kind. Okay. Next thing I draw your attention to again is completed years. So for this area here for N, we're looking for completed years, not part years, okay? And the last area here, apologies if you can't see that, L, it's really just the value of the tax-free pension lump sum at retirement age. And do bear in mind that the individual could be retiring, or sorry, being made redundant well before retirement. But don't worry about this pension lump sum because that should be, or will be, in fact, given in the question, okay? So in terms of detail here, let's have a quick look at an example. Again, this is FA12, the BPP text, page 39. I will be updating these videos in due course, so don't worry about that. Okay, so we're continuing on from the previous example for John, and we're given some information in order to be able to calculate the SCSB. And really the information that we need is what are the salary levels in the BIK for the previous 3 years leading up to the date of a termination of payment. We're also given a pension lump sum value, thankfully, of 4,000 euros. So really what we need to do is really to slot the numbers, the correct numbers, into the formula that we were looking at earlier on. Okay, so in terms of the answer to this question, Just on the next page, you'll see here that what we had to do is to calculate the average annual emoluments, pay, and benefits in kind, given the information that we had. And that was fairly straightforward, probably a little bit more complicated in June when we have to do this. It may well be that the figures aren't given to us nicely. In other words, we're not given the termination or the values of the remuneration, including pay and BIK, up to the termination date. It may well be that we're given them for tax years, and we have to prorate them. I've seen John Morrison, your examiner, do that once or twice. Okay, so just watch out for how you're presented with the information. Perhaps it may be that you have to calculate one element of pay and BIKs. Okay, so we end up with an average of 43, and all we're looking to do is to slot that into our formula. Okay, note that the figure on the top half of the fraction here is completed years, completed years. And in addition to that, we're just deducting the value of the pension lump sum. Now, when we slot those figures in, we come up with a value, or in effect a tax-free value of 36,133. So in essence, what we're saying is that we've done our calculations, and this is the element that will be tax-free. And as you'll see from the narrative below here, in this instance, they're assuming an amount of taxable termination payments of £50,000. We're seeing that the SCSB is greater than the basic exemption. It's also greater than the increased basic exemption of 26,870. So in effect, what we're saying is because the 36,133 is the highest amount, then that's the amount that's tax-free. And therefore, the difference between the 36,133 and the £50,000 of the taxable payment is in effect what will be taxed, and that makes it 13,867. Okay, so moving forward, one next point. Now, just to recap here, we have three main areas for an individual who is under Schedule E, and three areas that we have to attend to, or three exemptions. You remember the Terminator 3 slide. Okay. Now, if all else fails and the individual has some element of foreign service, it may well be that at that point, after calculating the highest amount of the three exemptions, we still have some amount taxable. So here's our sort of get out of jail card. And what we're doing here is we're saying that the individual who has had some taxable redundancy pay or some taxable termination payments, and they're about to be put into the income tax computation, it may well be that the individual can still avail of what we call the foreign service rule. And on that basis, the amounts can still be 100% exempt. Now, in order for this to be in play, we've got, again, three conditions. There's always conditions if we're getting something from the revenue. And the conditions for the amount to be 100% exempt are really any one of these three. So what we're saying is the first one is, well, we have a situation where, let's say it was the individual John. We've done our three calculations for the basic, the increased basic, and the SCSB. But we also see that John has had some foreign service, and if John's foreign service is under the condition 1 more than 75% of total service, then the amounts that are shown as taxable are going to be completely exempt. Okay, and second one here, if foreign service is the last 10 years, in other words, the last 10 years have been John working outside the Republic of Ireland on foreign service, then again, 100% exempt. Okay, and then the third condition, and we just really have to remember these, is that if we have 50% foreign service, including 10 of the last 20 years, then again, we can use our get out of jail free card. Okay, so we're going to just look at a quick example where perhaps those three possibilities aren't in play. In other words, we've done our three calculations, and that yet still we don't satisfy any of those conditions. So is there anything else that can help us? Well, there is, because if we're not 100% exempt under the Foreign Service rules and the individual has some foreign service, then what we would do is, in effect, just simply reduce the taxable element, the element left over in proportion to foreign service and total service. So really what we're looking at is the taxable element times a fraction. So in this example here, again, FA12 for the BPP text, page 40, it assumes 7 years of foreign service. Okay, so what we had, you'll recall from the previous example, we had 13,867 left over. So that's just after we've used everything we could possibly use. And of that 13,867, what we're looking to do is to say, well, John does have some foreign service. So what element of the amount that still remains taxable can we get relief for? And I'll draw your attention to this area here, really the bottom of the fraction. What we're looking to do in this instance is actually to take the total years of service. As you'll see from the note here, it's the full period of employment, not complete years of service. Okay, so again, we work out the 13,867 less this additional exempt amount, and we're left with net taxable to bring into the income tax computation of 7,173 euros. Okay, so moving forward on this area, just one or two other tricks I'll draw your attention to that are often played by tax examiners, certainly under the P6 IRE banner. And the first one is what you might get is a situation where the individual receives an asset, let's say a car, as part of their termination package. And in that instance, that will be included under the taxable banner. Okay, in other words, the OMV of the car at the date of termination will be included as a taxable amount, and then we'll do our various calculations of various exemptions. In addition, number two here, payments in lieu of notice are normally contractual. In other words, they'll be laid out at the outset within the individual's contract of employment. So in that case, what do we do? Well, if a payment is in line with the contract of employment, then it's going to be taxable. Let's just remember that overall general rule. Okay, holiday pay, always taxable. In no circumstances will holiday pay not be taxable. Okay, and then statutory redundancy pay, always exempt. Okay, these sorts of things you're going to really get by rote learning, a certain amount of rote learning and a certain amount of question practice. So just watch out for those four. Okay. Now, just one of two other issues in relation to this pension lump sum. You'll remember that was part of our formula for the SCSB calculation. Okay. Now, we're talking about sort of average emoluments to the date of termination over our years divided by 15 minus the pension lump sum. Now, we have a situation where, if you imagine in practical terms, we have an employee who's been made redundant or their termination or their employment has been terminated. And really, that could be long before retirement. Yeah. So what the individual is required to do by the revenue, perhaps a little bit unfair, is that they're required to irrevocably opt not to commute the pension to a lump sum. In other words, what the revenue are saying is, okay, you've been made redundant, your employment has been terminated, but in order to be able to have this calculation or to do this calculation, the revenue are really forcing the individual to make a decision well before their retirement in relation to their pension. And if you think about it, it may well be that the individual's circumstances, once they reach retirement, are different. It could be 20, 30, or even 40 years away. Okay, so a little bit unfair, but I'll just draw your attention to this idea that the revenue require a value for L. And in order to get a value for L, they're requiring the individual employee to make some sort of decision really long before the individual retires. So I do think that's a little bit unfair, but that's the rule, so that we've got to adhere to it. Just one other point, I mean, perhaps the individual has been in this occupational scheme only for a short time, and it may well be that the provisions of the scheme, the individual scheme, allow the individual to receive a refund of the contributions made, and in that instance they would be made under a deduction of 20% tax. But in that instance, in effect, L would be zero, because the pension scheme in effect wouldn't exist if we're refunding the contributions. Okay, so just watch out for that. Perhaps see, sort of maybe geared towards more a narrative style question than computational. Okay, last point here really is just this area of top slicing relief, and it's something that students have difficulty with, but it's not overly complicated. So I'm going to take you through it, and hopefully I'll be able to shed some light on it. So before I do that, let's just recap on where we are. We have someone who's employed. They've been employed for a number of years. Their employment is terminated. Yeah, and within the question that we see in June, there are a series of payments being made to this individual, or perhaps assets being transferred, etc., etc. Now, what we do is we go through the normal process. Remember our Terminator 3 calculations, a set of 3 calculations. We calculate what exemption is available. Perhaps there's even some period of foreign service, and remember we do that pro rata based on the full period of employment. And in essence, we're in a situation where the payment, the tax payment relating to the taxable amounts have been made through the PAYE system. So if that is the case, then when we come to do the tax return for the individual, there may well be another relief available. And what it is basically top slicing relief. And what that means in essence is that any taxable termination payment is taxed as the top slice of the individual's income. So in effect, attracting tax at the highest rate. And what this ruling says is that if you're in a position where the exemptions just haven't worked out for you, you've included an amount, it's been taxed perhaps through the PAYE system, then there may still be some relief available to you in the form of a credit in your income tax computation. So I'll just take you through how we would calculate this. In essence, what we're looking to do is to say, over the last 3 tax years, what is the average tax rate that the individual has paid? And once we have that value, we sort of compare that to the tax rate on the top slice of this taxable termination payment. So in essence, what we're saying is that the tax on the taxable termination payment in our current year, for argument's sake, 2013, is going to be limited to the average tax rate over the previous 3 tax years. Okay. Now, I would suggest that in June 2014, the value of this rate, in other words, the average tax rate, I think it'll be given to you. Yeah, so I don't think you'll have an issue with having to work that out. So in essence, what you're saying is what we need to work out, what we need to establish is what rate has the individual been taxed at. It may well be something straightforward like just the 41% rate. So we're looking at the differential between the average tax rate over the previous tax years given in the question and the marginal rate paid on the payments. Okay. So in terms of an example for you, I'll draw your attention to the example of BPP text. Okay, last area here is really this area of inducement payments. Okay, so sort of, I guess, linked into this area of perhaps someone leaving or indeed joining, and within the question we should see the value shown as inducement. In other words, we should be looking out for that word, the individual has been induced in some way. Okay, now it's fairly straightforward to deal with this area because inducement payments are 100% taxable, so they'll go straight into the income tax computation. The only caveat there is if the individual has had some loss of rights, and I think the example that I'd refer you to within the BPP text for FA12 is perhaps amateur sports people where they're giving up some sort of right and if that is the case, then the amount wouldn't be taxable. Okay, but I would suggest that John Morrison, your P6 examiner for June, is likely to come at that in a fairly straightforward way. Really, we're talking about fully taxable. Any payments that are inducement payments are fully taxable. Okay. Now, in terms of where you could sort of bring this all together, I'll just draw your attention to the BPP exam kit. Question 17, again for FA12. I would have a look at this. This is the typical way that your examiner, John Morrison, will come at this area. You'll see that you'll be given some background in relation to this individual, and you'll see here that you've got a series of different payments that the individual has received. So really what you're looking to do is to say, well, what is in my taxable list, what's in my non-taxable list, and calculate the exemptions. Okay, I'll draw your attention just very quickly to the answer. So this is a cut and paste from the report prepared in relation to Niall Golden. And really what you're looking to do is to provide some sort of background in relation to how termination payments work, and in addition, some detail relating to each of the items that were shown on the previous slide. Okay, so I draw your attention to that. Do have a look at that question, be quite helpful for you. And hopefully this short screencast has been of help to you. I think this area is very, very examinable. I think working through the questions will help you. Do remember those first three sort of exemptions, and that the individual can take the highest one. Moving on from the highest one of those, we've got the possibility of the foreign service relief coming into play. That's either going to make the amounts 100% exempt based on one of those three possibilities, or perhaps more likely for John Morrison, the way that he tends to examine areas, more likely is that that an element of the amount will remain taxable. So they'll be looking to take the total period of foreign service, in our case, I think it was 7 years, over the total period of employment, to really strip out that element of that further element of exemption. Okay, I'll draw your attention also to that formula. We need to know that formula for the SCSB. And in addition to that, if all else fails, we still have the possibility of claiming top slicing relief. And as mentioned, that's an area that students find difficult. But if we think about it, really, if all else fails, we've had some tax paid through PAYE for the individual, and we're looking to prepare an income tax comp, or perhaps the tax return, and we're really looking to put in a tax credit based on an average tax rate over the previous 3 tax years, and that should be given in the question. And then we're looking at the marginal tax paid by the individual in the year, and that's perhaps likely to be 41%. So average tax paid less marginal, and the credit would be based on that amount, along with other credits. Okay, so hopefully that's been helpful for you. Part 2 coming up in relation to share schemes, and thanks for listening.